Hello everyone, Lewis Crumpton here, and this is not financial advice. I'm really looking forward to this one because I get to expose some utter nonsense that is out there online. So make sure that you watch this video all the way through, as I'm going to be dropping the fire on some of these and revealing to you how you can find strategies that actually do work and the reasons probably why they work. Now, if you want to learn about how to do money better, how to make more of it in less time, then like this video and subscribe to the channel. Now, I am insanely invested in sharing with you this type of content. Why? Because I absolutely hate the traditional finance system and how it makes investing hard to understand for the everyday person. I want to turn that around by giving you the knowledge that they should have taught you back in school, but didn't. I wonder why they did that. To keep you poor, keep you broke, keep you controlled. Anyway, let me know in the comments something you think that they should have taught you in school, but didn't. I'll go first. How to invest in anything other than into a career that would, let's be honest, replace you if you died tomorrow. But off my soapbox for just now, and let me share with you just 5 of the investment strategies that do not work. The first one is trading in a range. Now, this one always makes me laugh because I remember hearing about it when I was a young 22-year-old spring chicken. And I remember my friend trying to explain to me how easy it was to make money in stocks because you just have to buy at this level and sell at this level, all done and dusted, nice and easy. Well, needless to say, he didn't become the next Warren Buffett. Now, this is the type of strategy that the old men at the pub talk about because they hear their financial advisors talking about it. The financial advisors who, by the way, do not know what they're on about. Some of you do, okay, but most don't. And they're just regurgitating something some overpaid broker said to get them off the phone one day because they've already made their healthy commission check off of your money. Now, trading in between a range attempts to take into account the fact that markets move between channels. Now, this is where price is trapped between one lower price and one higher price, and then it moves in between them. As an investor, being able to accurately identify those lines is an incredibly important part of learning to read financial markets. Now, this is why I focus so heavily on teaching this in detail within my training and within my mentorships. This strategy is often used by those who are maybe longer term investors and who want to apply it to stocks and to shares, although it can be applied to all types of markets. Let's say the price of gold, a commodity, ranges between 100 and 110. The range then is 10, and the belief system behind the strategy is that you should buy when it hits 100. That is buying at its lower range, and then sell when it gets to its upper range of 110, making a gain of 10 every single time that happens. That sounds great, doesn't it? Well, yes and no. The reason it sounds good is because it sounds so simple, like a magic pill. So easy and simple to make money that way. However, the reality of the markets and how they move and behave just isn't really like that. It's never really quite that simple. Walmart, for example, has made 4 round trips between $50 and $55, but it isn't perfect. It has gone lower and it has gone higher. That is also not a very high reward strategy, but it is high risk if you have a lot of capital. What happens if you buy at, say, $50 and then it goes down to $40? You want to be waiting around for a really long time. You won't be happy with that, will you? And you may have to wait a long time for it to come back up to where you are happy to then sell it at hopefully a profit. And you're probably going to struggle to make money by limiting yourself in that way to such small and controlled ranges. The second strategy that struggles to make any money is called rebalancing. The basic idea of this is that you will at different times move your money around to different asset classes like stocks, like bonds, like commodities, etc., while keeping the proportions constant. The idea is that as one does well, you sell it at its peak and then you buy those that are not doing so well at a cheaper price. Again, makes perfect sense, but rarely works out in that way. Now, I think it is a truism that the best investors, and by the way, we're talking long-term buy and hold investing here, not something like trading, which is what I primarily do, which generates phenomenal cash flow. Cash flow we can then invest into longer-term assets like I have done. So yes, when it comes to investing, it is often the laziest investors that actually do the best, those who kind of set and forget and don't worry too much about day-to-day or week-to-week movements. Some strategies work for a given period of time that they were operated in, and then people hold on to that strategy for life, even if it isn't working. There was once a time when this worked, but right now it doesn't work at all. You also need to ask yourself if you want to be that involved in the process, or would you rather be a low time investment investor, in which case just buy and hold something that you believe in, or maybe index trackers that over time should go up in value. The next one on our list is dollar cost averaging, and you may be surprised to hear me say that this doesn't work, mainly because in the past I've advocated for it, but that was in the past, and maybe I'll still advocate for it now, but hear me out here, because I am a dollar cost averager and will continue to be so, but there are things you need to know about this strategy to make sure that it does work for you. So if you are going to be doing this on an individual stock or an individual share, it probably isn't the best idea. Why? Because a low price stock that is diminishing is really high risk, even if you're getting it at a good price. 100% of nothing is still nothing. It is far better to be investing by using dollar cost averaging on something like an index tracker. Why is that? Because it is security and it is always the top companies within that country. So the FTSE is the collection of largest companies in the UK. The Dow Jones is the largest collections of companies in the US, and so on and so on. You've got the Nikkei, you've got all of those different ones. Now, this is a longer term strategy. So the earlier you start, the better. And there's different ways you can do that. And if you don't have a lot of money to invest on a monthly basis, then this really is your only option. And I personally think that it is a good one. It's like putting your money into a savings account each month, but one that will actually give you returns over time. On the flip side of starting this sooner rather than later, if you are in the later years of your life, this may not be the best strategy. I'm not going to define what later years of your life is, especially as we're heading into a recession during your later years. Your money will actually be shrinking and not growing. Now that will mean you have less to play with, not more. So you need to think differently. Another option that you could use as an investment strategy that I would personally not be going anywhere near would be binary options. Now this thing is vile, and I have a personal grudge against it because my dad ended up losing some money on this scam. I say scam because that is what it is. The reason I consider binary options to be a scam is because the odds are literally stacked against you. And they do that in a number of ways. With binary options, the old saying of the house always wins is correct. If you are trading binary, you are literally just rolling the dice and hoping for the best. Now, the way that binary options trading works is that you only have two choices, up or down. Hence the word binary, because you only have two options, binary options. Now, on top of that, you have to set a time frame. And that means that the market has to be either above or below your entry line at the time that it closes. Again, seems simple, right? Now, why is that simplicity a problem then? Why does that cause a problem? There's two major reasons why. One, when you actually trade, you will know that most positions you take will fluctuate between up and down in terms of where they're going to before hitting their target or their stop. Setting an extra time limit adds a level of complexity and possibility of not making money in that time. Second factor is risk and reward. With binary options, there is no way to place trades in a way which means you could make more than you lose. So it's always a one-for-one risk reward. Actually, it's always less than that. So if you're going for a one-for-one risk reward, which is our minimum, £100 risk would be £100 potential profit. Now that isn't terrible odds, but think about it. If you set that and you're stuck to that, you have to factor something else in. That other thing is the broker's fee, which means actually the one-for-one trade you think you're getting is risking more than you stand to make in profit. So this puts the odds firmly in the favor of that binary options broker. Not a fan. I remember in my early days of trading Forex and financial markets, I mean actual trading, not binary options. I've never traded it, never will. I was living at home with my parents, trying to save money to put into my trading account so I could grow my wealth quicker. My dad saw what I was doing and decided to get involved himself because he saw me make a success of it. Except he didn't ask me to help him. He didn't ask me to teach him. And I guess that's kind of like the pride of a father, even though he could see me making profits and traveling around the world with what I was doing. He still didn't want to do it. He still didn't want to ask me for my help. So one day I walked downstairs into the kitchen to make myself some lunch. my dad swanned in looking very, very pleased with himself and asked me how well I had done on the markets that particular morning. Now, I hadn't actually had a trade because nothing had lined up with my strategy. If it doesn't meet my strategy, I don't trade it. And my dad informed me, proud as punch, that he had made over £100 that morning trading binary options. First of all, let me tell you that one winning trade does not make a successful trader. I told that to my dad then, I'll tell it to anybody else as well. Just as one losing trade does not a bad trader make either. However, I had seen this pattern happen time and time again with people all around the world who I've been teaching and coaching who had previously traded using binary options. And it will be sod's law that there will be a binary options advert on this video, so please do not click it. Now, this process with my dad happened every day for about a week. He would come into the kitchen or come up to my office, which really annoyed me because he was distracting me, and he would gloat about how well he was doing. Now, I bit my tongue and I just waited because I knew what was going to happen. It was inevitable. I'd already advised him against binary options, but he had chosen to ignore me. Let that be a lesson to your dad. The next week, suddenly, Dad wasn't appearing in the kitchen. He wasn't making sporadic visits up to my office, and I still kept quiet and just waited, knowing that inevitability was probably starting to happen. Now, after about 3 weeks, I decided to break my silence and to ask him how trading was going, because binary is not trading and is not investing either. Now, he didn't really give me a proper answer, but it turns out that yes, the inevitable did happen and that he had lost the money he invested into that binary options account. Thankfully, my caution to him of keeping the account small was listened to, so he didn't lose too much, but more than I'd like him to. So to all the dads out there, if your kid is an expert in something, it's probably worth taking their advice every now and then. Don't let pride get the better of you. So with binary options, the broker will always win because they have stacked the odds to make sure that they do. When we actually trade as a form of investment, neither of those things are an issue. There isn't a time limit. There isn't the inverse risk to reward. And when I teach people how to develop their own strategies that improve their risk to reward and they are not trapped within a time frame, they do better. So they can either do that or they can take the easier route, which is using our tried and tested strategies rather than creating their own that have worked for many, many years for many people in many countries, creating sustainable profit. So in summary then, there are strategies out there that do work. Sometimes it is a case of the right strategy at the wrong time or in the wrong place. You need to align all three of those elements together to be a successful investor. Now, if you want to learn more about how to do money better, how to make more of it in less time, then like this video, subscribe to the channel, and now make sure that you share this video with someone that it can help or that it can inspire. Like and subscribe, and let me know in the comments if this has been helpful or what you would add to my list of things they didn't teach you in school. My name is Lewis, and this is not financial advice.